Hello and welcome everyone. In today's video, we will be taking a look at FEPI, which is the Rex FANG and Innovation Equity Premium Income ETF. It is the latest addition to the growing number of covered call ETFs. It trades on the US market, and I think it is one of the better ETFs on the US market, which not only generates income but also manages to capture some of the growth of the underlying holdings. So I'm not only going to review this ETF, but also compare it with other contemporary option income ETFs like the ones from YieldMax and Defiance to see if this is a better strategy. So without further ado, let's get started. When I first came across this ETF, I wasn't even sure if I should bother reviewing it because it seemed to have a very simple, straightforward option writing strategy. Basically, you own the underlying stock, write covered calls on it, and generate high income, which is basically the strategy that has been used traditionally in most covered call ETFs. But then, when I looked at its returns, the fact that it is generating an overall income of around 25%, and in addition, it has also managed to grow its capital. That's when I felt more curious regarding how this fund is managed. And to be honest, it is a very simple but effective approach. Mainly, they are prioritizing writing options that are out of the money, and they use a dynamic approach to decide how much out of the money the option should be in a given month. This way, if the price of the underlying stock does go up, then they are able to capture a good chunk of that capital gain, and they can use a combination of the option premium along with a small portion of this capital gain to pay out the monthly income. Thus, they are able to pay out a high income and at the same time retain some of the capital gain made by these underlying holdings. Most other ETFs prioritize receiving a higher option premium and sacrifice majority of the upside. For example, QYLD, arguably the oldest and the most well-known covered call ETF, writes at the money or covered call options. So they're sacrificing 100% of the upside. Most other ETFs also have a hard limit on how much out of money they can write, because the more out of money you're writing a call option, the less premium you're receiving. So this strategy used by FEPI, where they're using a very dynamic approach and writing higher out of money options, is something that works better during a bull market. It is also helpful that this ETF has only 15 holdings, which could work like a double edged sword. During a bull market, which we have been experiencing in the tech sector for the past quarter, this ETF could perform really well, especially with its high out of money option writing strategy. But I wonder how it would perform during a bearish market. Would they resort to writing more at the money options? We don't know that yet because ever since this fund started, the tech sector overall has been on a bullish run. Stocks like Nvidia and Meta have gained massive market value in the past quarter. Hence, it remains to be seen how this ETF would actually perform during a bearish market. In case you're wondering how these stocks are selected, we can find that information on their prospectus. As we can see over here, they follow the selective FANG Innovation Index, which consists of 8 core companies, which include Apple, Amazon, Meta, Google, Microsoft, Netflix, Nvidia, and Tesla. And in addition, they have 7 stocks, which are generally the top traded names from the sub industries within the tech sector, listed in bullet points on the screen. Now that we know how this ETF operates and what are its holdings, let us take a look at some of its risk factors. The most important risk factor is the fact that it is only operating within the tech industry, not to mention the fact that it only has 15 holdings. If we compare this with JEPI, which has around 130 holdings. It does appear a bit more risky, but at the same time, if we compare it with the yield max ETFs, which are all based on a single stock, then it is slightly less risky. Either way, the tech industry is quite volatile. And once again, right now we are going through a bullish period, but whenever we do go through a bearish period, I think this ETF will suffer massively. The second risk factor comes from its dynamic call writing approach. Once again, this dynamic approach has helped them capture the capital gain which they are paying out for now as income, while at the same time retaining some of the capital gain within the fund's value. But the dynamic approach brings on the table the management's ability to predict the market and take the right decisions. And this is something which hasn't been proven yet because the fund hasn't really been tested through a difficult time. So that's something we need to see and keep an eye on regarding how well the management will be able to manage the fund and its overall value during a difficult time. And last but not the least, its holdings. More importantly, its core holdings. As noted earlier, the fund has a total of 15 holdings, and 8 of those are core holdings, while the remaining 7 are more flexible holdings which can be reconstituted on a quarterly basis. So, even though the fund does have a dynamic approach when it comes to option writing, it does seem a bit rigid when it comes to its holdings. I just wonder what would happen if any of its 8 core holdings ends up having a major decline. Would they then reconstitute their core holding as well? Having said that, the core holdings, at least for now, are very profitable blue chip companies and should continue to be profitable for the foreseeable future. So, in conclusion, this is not a bad ETF overall. When compared with other US listed high income ETFs like the ones from YieldMax or Defiance, this ETF does offer the ability to capture the capital gains while also providing a high income of almost 25% annually based on its distribution so far. Having said that, it does retain the risk of being over dependent on tech stocks. More importantly, the strategy of writing out of money covered calls to capture the capital gains and use it to pay out income is working right now during a bullish market, but we need to wait and see how this strategy would work during a bearish market and how well the management will be able to preserve the fund's value during a difficult time. So, for now, I'm keeping a close eye on this fund's performance to see where it would stand in another 6 months. If it is still able to retain its 25% yield and also provide capital gains, I might even consider buying it. Even as a Canadian, this is not a bad option because even after accounting for the withholding tax, you would end up receiving somewhere between 20 to 22% income, which is more than what similar Canadian listed ETFs are paying right now, maybe with the exception of YTSL. So, overall, as I said, not a bad option, but it needs to be tested during difficult times. And that brings us to the end of this video. As always, do your own due diligence prior to making any investment decision. If you found some value in this video, don't forget to like, share, and subscribe. I will see you guys in the next one.